Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Liquidity Services, Inc. quarterly report. Liquidity Services, Inc. offers a diverse range of businesses and services to its clients across various industries. At the core of their operations are e-commerce marketplaces that enable government entities and commercial businesses to sell surplus property and real estate assets through platforms such as GovDeals, Bid4Assets, and Sierra. The company operates four distinct segments: GovDeals, Retail Supply Chain Group, RSCG, Capital Assets Group, CAG, and Machinio. Each segment offers a unique set of services tailored to specific client needs. For instance, the GovDeals platform provides surplus management, asset valuation, and marketing services for government entities. In addition to its marketplaces, Liquidity Services also operates Liquidation.com, a dedicated marketplace for selling excess, returned, and overstocked consumer goods. The company's Capital Assets Group, CAG segment offers asset sales, marketing, returns management, and asset recovery services to commercial businesses. Furthermore, the company provides a suite of software tools through its Machinio system service, including website hosting, email marketing, and inventory management for equipment sellers. This comprehensive range of services enables Liquidity Services to cater to various industries, such as consumer electronics, general merchandise, apparel, scientific equipment, aerospace parts and equipment, technology hardware, real estate, energy equipment, industrial capital assets, heavy equipment, fleet and transportation equipment, and specialty equipment. Overall, Liquidity Services' diverse portfolio of businesses and services positions it as a leading provider of e-commerce solutions for surplus property and asset sales across multiple industries. Unfortunately, I do not have access to the text you provided. However, I can provide a general essay on what may cause a stock's price to remain stagnant over a period of time. The stock price of Liquidity Services, Inc. has remained relatively unchanged in the past year, leaving investors and analysts wondering about the underlying reasons for this stability. One possible explanation is that the company's financial performance has been consistent but not spectacular, failing to generate significant excitement or concern among investors. This could be due to a lack of growth in revenue, earnings, or other key metrics. Another possibility is that the company operates in a mature industry with limited opportunities for expansion, making it difficult for Liquidity Services, Inc. to break out from its current trajectory. Additionally, changes in market conditions, such as shifts in consumer behavior or regulatory developments, may have had a neutral impact on the company's stock price. It's also possible that investors are waiting for a catalyst, such as a major acquisition or a significant change in management, to drive up the stock price. Alternatively, the company's valuation may be perceived as reasonable by investors, leading them to hold off on making any significant changes to their investment decisions. Ultimately, without access to more specific information about Liquidity Services, Inc.'s financials and industry trends, it is difficult to pinpoint a single reason for the stability of its stock price. However, these factors could all contribute to the company's relatively unchanged valuation over the past year. The income statement shows that the company revenue have been declining annually and operating income have not been increasing. This shows that the business is under pressure with rising cost and its management is unable to expand the business. The primary drivers of revenue growth or decline can be identified through an analysis of the extracted summaries. Revenue growth is primarily driven by the increase in consignment and other fee revenues, particularly in GovDeals and RSCG. In GovDeals, this growth was fueled by new seller acquisition and service expansion, resulting in a 12.3% increase in revenue from 2024 to 2025. Similarly, RSCG saw a 14.2% increase in consignment and other fee revenues during the same period. In addition to these increases, CAG experienced significant growth in purchase revenue, with an increase of $1.74 billion, 107.1%, from 2024 to 2025. Machinio and Software Solutions also reported a 27.5% revenue growth due to price increases, subscriber growth, and the acquisition of auction software. On the other hand, revenue decline is primarily attributed to RSCG's purchase revenue decrease by $6.69 billion, minus 8.3%, from 2024 to 2025. This was driven by lower purchase transaction volumes at RSCG's reportable segment. CAG also experienced a decline in GMV, decreasing by 10.3% due to prior periods including larger, lower take rate project work. Other factors contributing to revenue growth include the increase in registered buyers and greater adoption of users, creating a continuous flow of goods. The aggregation of buyer demand and market data enables a continuous flow of goods from corporate and government sellers, further driving revenue growth. The net income of a company saw a significant increase between 2024 and 2025, rising from $5,810,000 to $7,489,000. This growth in net income is a positive indicator of the company's financial health. However, despite this increase in net income, the profit margins experienced some fluctuations. The gross profit margin decreased by 2%, dropping from 42% to 40%. On the other hand, the operating profit margin saw an improvement, increasing by 2% from 6% to 8%. This suggests that while the company's overall profitability may have been affected by a decrease in its ability to maintain high gross margins, it was able to offset this loss with improved operational efficiency. The company's financial performance is a testament to its ability to generate significant operating cash flow. A key indicator of this is the positive operating cash flow, which has been consistently achieved in both 2024 and 2025 periods. According to the calculation on page 30, the company's EBITDA, earnings before interest, taxes, depreciation, and amortization, for these 2 years totals $11,904. When combined with depreciation and amortization expenses of $2,583, the resulting operating cash flow is a substantial $14,487. This impressive figure underscores the company's financial stability and its capacity to generate positive operating cash flow, a crucial metric for any business seeking long-term success. The company's debt level has undergone significant changes over the past year. Initially, it decreased from $171,859 on September 30, 2025 to $153,879 on December 31, 2025. However, this decrease was short-lived, as the maximum aggregate borrowing amount increased from $25 million to $35 million in May 2025. Most notably, by December 31, 2025, the company had eliminated its debt entirely. In terms of interest expenses, there is a mixed picture. On one hand, explicit mentions show an increase from $4 in 2024 to $5 in 2025. However, another instance reveals a decrease from $1,151 in 2024 to $1,196 in 2025. Despite these fluctuations, the overall trend suggests that interest expenses have not changed significantly. Management is optimistic about the company's outlook, expecting a significant portion of $4.9 million in remaining performance obligations to be recognized within the next 12 months. They attribute this growth to industry trends, such as increased volume of returned merchandise and government regulations, driving sustainability solutions. To capitalize on these trends, the company is focused on expanding its buyer base through internal and external marketing efforts. In terms of strategy, management is investing in innovation, including AI and machine learning capabilities, to enhance marketplace platforms. They are also leveraging strategic acquisitions, such as Auction Software and Sierra Acquisition, to expand their offerings and presence. Additionally, they plan to fund capital expenditures from existing cash balances and operating cash flows, with future requirements dependent on revenue growth, development efforts, sales and marketing activities, and warehouse expansion. Overall, management is positioning the company for long-term growth through strategic investments and acquisitions. The company's financial activities have been closely monitored over the past period. One notable transaction is the purchase of its own shares through a process known as share buyback. This move has resulted in a significant reduction in the number of outstanding shares. According to the Changes in Stockholders' Equity section on page 16, there is a negative amount, minus $93,854, associated with this activity. This indicates that the company has indeed bought back its own shares, reducing the total count and potentially impacting shareholder value. Concerns about inventory buildup and supply chain disruption are valid based on recent data. Inventory levels have increased by $227 from September to December, indicating a potential buildup of stock. Furthermore, significant purchases under contracts with Amazon.com, Inc., totaling $10.6 million and $10.1 million, suggest that the company is accumulating inventory. Supply chain disruptions also pose a risk. Tariffs and trade barriers may impact the availability of assets to list on marketplaces, while global supply chains are expected to experience heightened disruptions due to international tensions and other factors. Additionally, a decrease in gross merchandise value, GMV, by 10.3% in the energy category suggests that supply chain issues may be affecting sales. These concerns highlight the need for careful management of inventory levels and supply chain operations to mitigate potential risks. That concludes the financial summary for Liquidity Services, Inc. Feel free to comment below, and I will be happy to answer them when possible.